In today's video, we are going to look at a situation where an individual knows what he wants. He's interested in a whole life insurance policy. He knows how much he wants to fund the policy with. He has a lump sum that he'd like to start his policy with, but there's just a couple things I wanted to show him with respect to different options and what the policy would look like. So to jump on into it, we've got a situation where he's ready to start a policy and he knows what he wants. We've got a young guy here, 26 years old. Him and his wife are interested in a policy. With respect to the company selection, we're looking at Guardian. A big reason why has to do with that flexibility. So Guardian is one of your major mutual companies, and when you look at their PUA rider, it is extremely flexible. He can commit to a minimum amount and add more funds to PUAs at discretion, which is what he wants to do. So his intention with respect to the funding amount, in the first year, he wants to begin with a lump sum, which will be anywhere from $50,000 to $100,000. So he knows what he wants. The only question he really has right now, it's more of a question for himself, is should I start with 50 grand or 100 grand right out of the gates? From that point forward, beginning the second year, $25,000 per year is the maximum he wants to fund the policy with. The number of years, right now, 10 years is what he's thinking. These policies are designed to allow funding for a longer period of time, but in this video, we're going to look at a 10-year funding scenario, as that is what he was interested in, what he mentioned when he completed our form and let us know exactly what he was looking for. Now, his interest is this. He's interested in using a policy, the cash value specifically, for a family bank and other opportunities. So when I say other opportunities, specifically what he referred to was other investment opportunities, whether that's real estate investments in his business, if he has one, or if he decides to start a business in the future, meaning he wants to be able to access this cash value for opportunities as they arise over the years, as he is younger right now. He's off to a great start. So, some details here. Here's what we're going to focus on in this video, is this guy, this lump sum of $50,000 to $100,000 and then $25K per year thereafter. Can he do that? The answer is yes. It strongly depends on the company choice and what their PUA limits are. Guardian did not always allow this. What's Guardian's limits with respect to the minimum premium and then the maximum amount you can pay into a policy? When we design a policy, the maximum we can illustrate is typically 10x whatever the base premium is in PUAs. So for example, if I have a base of $1,000, if we have a 1-year term rider attached, the most we can illustrate here in PUAs is 10x that, as long as the 1-year term rider is attached, which would be an additional $10,000 per year, which will give me a yearly total of $11,000 per year. So with that said, while that is the maximum we can illustrate on a regular basis, that's been their practice. However, they recently made a change where they allow up to 50 times the base premium to be funded in the first year alone. This happened toward the beginning of 2022 when there was a large change in the insurance industry and they made some revisions, particularly around their PUA rider and limitations. So in the first year, what we can illustrate now is 50x the base premium. So what that means is if you have a base premium of $1,000, in year one only, you can illustrate how much? That'd be $50,000 into PUAs. Now to do that, you need a very high death benefit in order to prevent a MEC from occurring, which means we need a lot of term insurance. Now he's very young, so a term insurance rider will be very, very low with respect to the cost, and eventually we do drop the term rider as well. So it can work out quite nicely in this case. But to go through some details here, here's what we've got. The yearly minimum, what he wants to commit to, is $2,500. He let us know this very specifically. I'd like to have a policy where I can commit to $2,500 per year and then have a maximum of $25,000 per year, with the exception of the first year, Steve, where I want to fund either $50,000 or $100,000 right out of the gates. So I'm going to stuff it initially. From that point onward, the max will probably be about $25,000 per year. So small side note here. Adding a lump sum does require a large term rider to be attached. As a result, the minimum requirement will be slightly higher than $2,500. You'll see it is slightly higher when we look at the different scenarios. But to get that true minimum of $2,500, if he was just funding a maximum of $25,000 per year, that would be very easy to attain, especially at his age. However, with the additional term insurance, you'll see the minimums are a bit higher, right around $3,000. The 100K lump sum is a little bit higher than that, but you'll see the exact numbers. The last thing I want to touch on here, with Guardian, the product we looked at is their L95. And regarding their PUA rider, they've got two versions of this that are available with the L95 product, which is a 5% and a 10% PUA fee. The 5% will give you more upfront, the 10% will give you more long-term based on the non-guarantees. If you're focused on the guaranteed values, the 5% will give you more from start to finish. So let's take a look at the numbers. So let's begin with the $50,000 lump sum scenario. And what I want to hit on here is what his minimum commitment is and then where the money is going. So minimum commitment. On the illustration, you'll see it up here. Here's your base premium, $22.75 in this particular case. Okay, so that $22.75 gives us a whole life death benefit of about $180,000, which in his particular case will give him a MEC limit probably of about $7,000 or $8,000. Very, very low, not 50K. That MEC limit is that taxable line on a life insurance policy. If a policy becomes a MEC, we cannot access the cash value tax-free. If it's not a MEC, we can access the cash value tax-free. There are other cases that can trigger a taxable event, which I would check out this video for more information on that. But how we prevent a MEC here is with this guy. What this is term insurance. We are adding a term insurance rider to our policy, which is a strategy to keep the base premium low, because remember, that does not show up in cash value in the first year. That's why we want to minimize it. So here's a low cost to add more death benefit. Add those two figures together, 1.46 million, which you'll see down here on the net death benefit. Kind of an oddball death benefit, isn't it? What we did here was solve for the minimum amount of life insurance needed to give him the MEC limit of what? $50,000. Minimum insurance expense in order to maximize cash value. What he is committed to on a yearly basis is the premium and then that term rider cost. So if we round that up to $500, what are you at each year? Call it $27.75. So we rounded it a little bit differently. You'll see the exact numbers in a minute. But as we look at this, what do we have? So the funding displays max funding every year. First year, $50,000. First year cash value, $46,000 and change. That's rich cash value right out of the gates. Paid up additions rider. When you see STP, that represents the 5% PUA fee. You'll also see this in the full illustration on page 2 or 3 in most cases. It'll be at the bottom of page 2 or top of page 3. So looking at this, rich cash value right out of the gates, but he paid in $50,000. Did he get the full $50,000 back? When we look at this particular case, no, he did not, because he only has $46,000. However, look at the next year. He pays in $25,000. The cash value was $46,000. Now it's $72,000 and change. If he had $46,000 under his mattress, earning 0%, and he added $25,000 to it, what would the value be next year? Or after he adds that $25,000? It would be $71,000 and change, but it's $72,000 and change. That represents the fact that he received his $25K back plus some earnings from the insurance company, a combination of dividends and the guaranteed portion. And you'll see it continue to accelerate over time. I like this column, cumulative net after-tax outlay, because it tallies up our total payments. And we see the break-even point occurred between years 3 and 4 in this example. By year 3, he's paid in a total of $100. Cash value is $99. Year 4, $125. Cash value is 126, almost 127 when we look at the value. So he's positive there. Perfect. Now, let's look at the 100K scenario. Look at one thing. Keep your attention focused on this and then also this. So this is the first year payment and this is your minimum base premium. Have those numbers in mind? Okay. Premium, identical. First year payment, double, $100,000. Something else popped up on this illustration. Did you notice what that was? RTR 10. What that represents, or what it stands for, is a renewable term rider. This is an additional term insurance rider. So we have two term riders. Here's the first. Purpose of the additional term is to do what? Get the death benefit higher, which again raises the MEC limit for the individual. Now, we've got a MEC limit of $100,000 instead of $50,000. And what I'll add very, very quickly, adding a lot of term insurance does come at a cost. However, the thing I always like to look at is this. Does adding more term result in lesser costs than what I would otherwise have with a higher base premium? Meaning the reason why I'm adding so much term insurance to the policy is because I'm keeping the base premium low. Both the base premium and term insurance rider drive my total death benefit, which have a direct relationship to the MEC limit. So the goal here is, if my objective is to maximize cash value, is how do I get the death benefit at the dollar figure needed to give me the MEC limit I want? So here he wants to pay in $100,000. So I need a MEC of 100K. And what's the minimum death benefit needed to acquire that? $2.9 million in this case. Okay, how do I achieve that death benefit at the lowest possible cost? Which also allows me to commit to the minimum dollar amount. So some technical details there, but when adding term, if that results in the lowest cost, both on the guaranteed and non-guaranteed values when I look at everything, that will result in the greatest overall cash value, especially looking at the guarantees. And looking at this guy, what do we notice here? Well, the premium has not changed. There's your base premium. You added a little bit more in term. So you've got about $700 here. Got your term rider down here, another 500 and change. So you have added a little bit more cost, but you plowed in a whole lot more into PUAs. So as a result, 100 goes in, and look at this. First year, you've got 94% of what you paid in available cash value, and this is a non-MEC policy as well. So he does have access to the cash value. Break-even point is very similar, just about there year 3, where you've paid in 150, your cash value is 149 and change. In year 4, there's your break-even point. And again, when we look at the funding here, $25K per year for 10 years, but he can continue to pay in $25,000 per year. He's got plenty of term left. He could pay in $25 a year, which is 10xing that base premium for at least another 5 years. It'll be between 5 and 10 years, between 5 and 7 years really when you look at this, but he can continue to feed this policy if he wants to, which he's a young guy, so he very, very well may want to do that. Let's take a look at the comparison, because the illustrations we looked at were all demonstrating the 5% PUA fee, and the 10% PUA fee will look identical to this from a design perspective. The difference will be a 10% PUA fee. As a result, the term cost is usually slightly higher. So let's take a look here. And when we look at the comparison sheet, the 10% PUA fee will be on the left. What we also included in this case are the internal rates of return. We've got our annual internal rate of return and also our average internal rate of return. So you've got the minimum premium here. You can see we rounded off there, $27.50, the base premium and the term. Same thing with this guy, because these two are the same. This is not a $500,000 lump sum, a $50,000 lump sum, and then $25,000 per year. So first year, 50 goes in, 10% PUA fee. What happens in the first year? You've got almost $44,000. The hit you take, you paid in 50, you've got 43 and change. That's a negative IRR of a little over 12.5%. The lower PUA fee, what happens? 50 goes in, there's your IRR in the first year, negative 7.71%. So you've got more cash value up front, got an earlier break-even point. Over here, it's year 5. However, if you look at it over time, what do you notice by year 10? They're very similar. Year 11, they're almost identical. And then by year 12, that 10% PUA fee begins to overtake the 5% PUA fee. And look at your annual internal rate of return. So the annual IRR isolates what your policy is growing by year over year, net. When I say net, what I mean, because sometimes people have questions on that, here's what the net means. Dividend rate is 5.75%. This is with Guardian. Your cash value is never growing by that amount. The annual IRR simply isolates what the net growth rate is after all expenses. So you've got your gross rate here, then after the insurance company's expenses and everything that comes with the policy, what did my money actually grow by? Meaning if I look at year 11, end of year 10 we will begin with, I've got $318,000 in change. Year 11, I paid in zero. Over the course of that 12 months, the end of the next year, I'm at $333,000 in change. If I associate a percentage with that, it grew by 4.86% for that year. Hence the term annual IRR. I am isolating each year. The average will take into account all years. It'll be slower moving because I'm negative right out of the gates. So granted it gets better over time, I still have to make up for that negative hit initially. But when you compare the two, both crack 4% quite a bit, but you do notice a difference there. And what I'll say is this is not a recommendation that I like to give to say I would go with the 5% or I would go with the 10%. It's always up to the individual. Now, if they say, hey, what do most people do? Or how can you help me make the right decision? I would say something along these lines. If you like stronger guarantees, the 5% PUA fee will give you that. When we look at the guarantees side by side, the 5% PUA fee will have more from start to finish. So for those that are very conservative or just like to look at things as conservative as possible, the 5% PUA fee is a nice option. If you like the idea of having more cash value up front, because that's just going to sit in your stomach better, you're not going to be looking at it thinking, I'm taking these hits there, it doesn't feel good, I don't like it. The 5% PUA fee might work. Someone on the flip side might look at this and say, all right, when I look at the difference here, like by the time I'm 30, the difference is $5,000. I don't think that I'm going to need access to the additional $5,000. And I like what this gives me from a long-term potential standpoint. So I'm going to go with that option, the 10% PUA fee. The one thing that I will stress, and I just want to make sure people fully understand, is that it is potential. It's based on the non-guaranteed side of an illustration. Looking at the guarantees, it's the opposite. As long as one knows that and is still comfortable, perfectly fine in my opinion. All right, so let's look at the 100K option and we will wrap up with that. So 100K, in the first year, we've got the exact same thing here, but just $100,000 right out of the gates. And the majority of that additional $50,000, because the first one we looked at 50K, now we've just added another 50K into PUA's slight term cost addition, but for the most part, it's going into PUAs. What happens? So with a 10% PUA fee, that looks good out of the gates. You've got almost 90% of what you paid in. What's your minimum look like? $3,500 and change. And again, that includes the base premium plus the term rider. I should say term riders because there's two of them. Looks good, breaks even. Year 5, it's really between years 4 and 5 to be fair. And then looking at this guy, 5% PUA fee right out of the gates, 94 to 95% the first year, breaking even between 3 and 4, looks good. But again, same product here, just different PUA option. And whichever one you pick, you are locked into that for the life of the policy, with the exception of the first 120 days where you can make changes. After that, you're locked into whatever choice you made. Unfortunately, at the time of shooting this video, Guardian does not offer both options with the product or anything like that. I don't know if they ever will, but changes have occurred over time and changes will continue to occur. So I found that I like to say at the time of shooting this video. In any event, I hope that you found this video helpful, especially if you're in a similar situation, if you're looking at a policy with a lump sum and then want to fund with a lower dollar amount. That gives you an idea of what it may look like. Question that comes up sometimes in cases like this is this: hey, that individual is 26 years old, I'm 46 or 56. Would it be similar for me? The answer is yes. Would it be identical? No, but it would be similar from a cash value perspective. We would still design the policy with the minimum premium. We would add term insurance. We would fund up to 10x or 50x if that's the particular goal or if that suits you in your situation. But from a cash value perspective, you can attain similar results. It is true on the flip side, as we grow older, that term will be a little bit more expensive, but in 99 out of 100 cases, even for people in their 60s and 70s, from what we've always seen, keeping a low base premium and adding term to it is a great way to keep those costs low, keep my minimum premium very low, and allows me to add funds into PUAs at my discretion being me the policyholder or you the policyholder. Hope you enjoyed it. If you did, please let us know. Let us know if you picked the 5% or 10% PUA fee, and if you like the 100K or 50K lump sum option down below. I'd love to see what your thoughts are. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.